Here's something that might sting a little. Morningstar did a study on retirement accounts. They found that putting the wrong investments in the wrong accounts costs retirees an average of $112,000 on just a $1 million portfolio. Not because they picked bad stocks, because they put the right stocks in the wrong place. And the account where this mistake hurts the most? Your Roth IRA. Think about it. Your Roth is the only account where every single dollar of growth is tax-free, forever. No taxes when it grows, no taxes when you pull it out, no required minimum distributions forcing you to sell, not even taxes when your kids inherit it. And yet millions of people fill their Roth with bonds and cash. That's like owning a race car and never leaving the driveway. By the end of this video, you'll know the exact 7 ETFs that belong in your Roth right now in 2026. I'll give you the specific percentages based on where you are in life, and you'll see the real data behind every single pick. But here's the twist. One of those 7 funds, the one almost every financial channel recommends for a Roth, actually doesn't belong there at all. I'll show you which one. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. The Foundation, VOO, and the 2026 concentration problem. If you've watched any investing video in the last 10 years, you know this name, VOO, the Vanguard S&P 500 ETF. 3 basis points expense ratio, nearly $1 trillion in assets, a 10-year annualized return of about 15% per year. This is still the bedrock of any serious portfolio, no question. But here's what changed in 2026, and this part matters. Right now, the top 7 stocks make up roughly 35% of the entire S&P 500. That's more concentrated than the dot-com peak in 1999. 7 companies, 35 cents of every dollar. The Buffett indicator, which measures total stock market value against the economy, is sitting at record levels, somewhere between 219 and 236%. For context, it was about 150% at the dot-com peak. So what does that mean for you? It doesn't mean dump VOO. VOO is still the foundation. It means you can't just buy VOO and walk away, not in 2026. Smart investors add the next 3 funds to harness that concentration, instead of being a passive victim of it. And one of those 3 has a crash history that's actually shallower than the S&P 500 itself. That surprised me too. The growth accelerators, SPMO, QQQM, and VGT. This is where your Roth starts working overtime. 3 funds designed to amplify growth inside tax-free space. First up, SPMO, the Invesco S&P 500 Momentum ETF. This fund picks the top 100 or so S&P 500 stocks based on price momentum over the last 12 months. It rebalances twice a year, March and September. The 10-year annualized return is about 20% per year. Now, here's what most people don't know. The momentum premium, the idea that winning stocks keep winning, has been documented all the way back to 1801, over 200 years of data. It's one of the most persistent patterns in all of finance. And here's what's counterintuitive. SPMO's worst drawdown since launch was about negative 31%. That sounds rough, until you compare it to VGT, which dropped negative 55%. Momentum rotates out of collapsing stocks. That's its built-in safety valve. One more detail. SPMO has about 44% annual turnover. In a taxable brokerage, that creates taxable events every year. Inside a Roth, none of that matters. 0 tax drag. That's exactly why this fund belongs in your tax-free account. Next, QQQM, the Invesco NASDAQ 100 ETF. Same index as QQQ, same 100 companies, but the expense ratio is lower, 15 basis points versus 18. For a buy and hold Roth position, QQQM is the smarter pick. Here's a detail nobody talks about. QQQ actually converted from a unit investment trust to an open-end ETF in December 2025. QQQM was already structured that way. For long-term Roth holders, QQQM was always the cleaner choice. Third, VGT, the Vanguard Information Technology ETF. This is pure conviction tech, over 300 U.S. technology companies, 9 basis points expense ratio, and the highest 10-year return of any fund in this lineup, about 25% per year. But let's be honest about what you're holding. The top 3 names, NVIDIA, Apple, and Microsoft, make up roughly 45% of this one fund. Now, here's the overlap reality you need to see. When you stack VOO plus QQQM plus VGT, your combined tech exposure is about 70%. Most channels don't tell you that. I will. That's not a mistake inside a Roth. It's a deliberate choice. Tax-free compounding magnifies growth. The whole point of a Roth is to lean into the highest growth assets you can find. But you should see the real number and choose it with your eyes open. Now, about that 22% per year figure. Here's the myth. You can reliably expect 20% plus returns going forward because that's what these funds delivered over the last decade. Here's the truth. Those trailing returns happened during one of the strongest tech-driven bull runs in market history. They're real, but they're backward-looking. Honest forward expectations for broad equities are more like 7 to 12% per year, potentially higher with a growth tilt. The Roth's power isn't in predicting returns, it's in sheltering whatever growth you get from taxes, forever, and that's worth more than any percentage. So now you have 4 growth ETFs locked in, but right now you're sitting at nearly 100% US exposure, heavily tech, and something happened in early 2026 that should make every smart investor pay attention to what's outside America. The diversifiers, VXUS and SCHD. VXUS, the Vanguard Total International Stock ETF. 5 basis points expense ratio, about 8,700 stocks across developed and emerging markets. Now, I know what you're thinking. International has been dead money for years, and for a long time, you would have been right. But here's what most people missed. In the first quarter of 2026, the international benchmark fell just negative 0.6%. The U.S. market fell almost negative 4%. International outperformed America, and the dollar weakened through all of 2025. The U.S. always wins narrative is being tested right now. You don't need a huge position. Even 10 to 15% in VXUS gives you a hedge against the very concentration you're deliberately leaning into with your growth funds. Smart diversification, not fear, just math. Now, let's talk about SCHD, the Schwab U.S. Dividend Equity ETF. 6 basis points expense ratio, a yield of about 3.27%. But here's the number that matters most, and nobody talks about it. SCHD's dividend growth rate is about 11.5% per year. That means your income roughly doubles every 6 years. Inside a taxable account, those dividends get taxed every single year. Inside a Roth, every dividend raise compounds permanently tax-free. Let me show you what that looks like. A $10,000 SCHD position today pays about $327 a year. In 6 years, that's roughly $650 a year. In 12 years, about $1,300 a year, all tax-free. That's the cheat code. Before I show you the exact allocation blueprint and the fund that doesn't belong in your Roth at all, drop a comment right now. How many of these 7 ETFs are already in your Roth? I read every single comment, and I'm curious where you stand. You know all 7 funds now, but knowing what to buy is only half the answer. The real question is how much of each, and the answer changes completely depending on where you are in life. Plus, I still owe you that one fund in this list that doesn't belong in your Roth at all. The exact allocation blueprint, and the fund that doesn't belong. Let me introduce you to Janet and Paul, age 52, from Michigan. They've got $180,000 in their Roth, and right now, $25,000 of it is sitting in SGO, a short-term treasury fund earning about 3.5%. In a taxable brokerage, that's a perfectly fine move, but inside their Roth, over 20 years, that $25,000 at 3.5% grows to about $50,000. The same $25,000 in a growth ETF, averaging even 10%, grows to about $168,000. That's $118,000 they gave up, and every single dollar of that would have been tax-free. SGOV is not a bad fund. It's a great parking spot for cash. But your Roth is not a parking spot. It is a tax-free growth engine. Put SGOV in your taxable brokerage. Put your highest growth funds in your Roth. That one decision is worth more than any stock pick you'll ever make. And here's why 2026 makes this more important than ever. Secure 2.0 now requires anyone earning over $150,000 to make their catch-up 401k contributions on a Roth basis, starting this year. More money is flowing into Roth accounts than ever before. The 2026 contribution limit is $7,500, $8,600 if you're 50 or older, and that catch-up amount is now indexed to inflation for the first time. Every dollar counts. Make them count in the right place. Your Roth is your tax-free runway. Every dollar of growth the IRS can never touch. Don't waste that power on funds that barely move. If someone you know has a Roth IRA and isn't sure what to hold inside it, send them this video right now. It could save them 6 figures over their lifetime. What's the biggest change you're making to your Roth after watching this? Drop it in the comments below. If you're building tax-free income from your investments and want to stay ahead of changes like the Secure 2.0 rules, subscribe to this channel. I cover everything that protects and grows your money. And if you want to see exactly how much monthly passive income these ETFs can actually generate in retirement, that video is coming next. The real numbers might surprise you.